Good afternoon, everybody. Many of you know me. I'm Sonny Barkats. I'm the founder of JS Barkats, a growing small-cap law firm. We do a lot of corporate securities. We are 22 lawyers, litigation, real estate. We represent funds. We represent issuers. We have been in this industry for a while on the individual level and as a team. Michael Wheeler here on my left is a top and rising star at the firm, a senior attorney, also in the entertainment and the securities field.
We've got about 22 lawyers. Like I said, we're a growing law firm. We're a little bit more dynamic than the typical older firms that have been established. We typically work with small emerging market companies that are looking for alternative capital market raises. And Sonny's one of the specialists in Regulation A. He's a market leader. We did about 13 in the last 2 years, and we've already gotten solicited more to come, and working on a couple clients that presented here, and they have used us on Reg A offerings as well.
Absolutely. Great presentation for Gastromedics and CardioMax. We're not biased. We think they are a great company. You should look into it. On a side note, there is a couple of booklets that I wrote. I think I'm a great writer. I suggest that you pick up the booklet. It's about the use of finders in the securities industry. And I think it would be very helpful for everybody to know the boundaries on who can or can't get a commission. That's why we support NIBA, an educational group that allows placement agents, bankers, brokers to know what is permissible. So let's go into the core of the subject. We are here to take questions, but we are going to kickstart this discussion by talking about a couple forms of financing that are available for private and public companies right now that are hot in the market. So I would say the main issue that issuers face is that they are not structured in a way that is attractive to investors. We think that the most important thing is to surround yourself with a great investment banker, a great law firm, certainly a great accountant, to figure out a structure that is attractive to investors. What are those structures? So definitely people, based on the fundamentals, we looked at management, and that's key. If you have a bad management, don't even try to raise money. But if you have a management that has some skill sets, some credibility, and some value, then you need to know who you're talking to. And the audience is mainly technical financing on the early stage of most companies, especially in our world, the small public market world. You need to know that there is no such a thing as bad money as long as you know how to use it, leverage it, and get out of it, and replace it with a different type of financing. There is no such a thing when people come and talk to us and tell us, oh, I did a toxic financing, I'm stuck with those lenders, they are bad lenders. Yes, those guys are going to do what they do. They didn't hide it. You probably knew, if you listen to the reality of it, what they were going to do. You took their money. But if you structure it right, there is a way to substitute that so-called toxic financing into different form of equity, debt, and a pipe alternative. That's for the public side. On the private side, there is great alternative as well. If I told you that today a lot of people are leveraging more and more, not a lot, but more and more people are leveraging Regulation A offering. So I'm going to give you a little story. In 1986, the famous ice cream company of Ben & Jerry was about to bankrupt. They had been pushed out of every store by Häagen-Dazs, and they didn't find a way to regain market credibility, and they needed capital. What they did is they took their little ice cream cup and put on the ice cream cup a prospectus under Regulation A in the state of Vermont. They basically raised money from non-accredited investors without audited financials for $1.5 million, which was equal at the time. It was raised by 1% of the entire population of Vermont. Those tools exist since 1936 and are an amendment to the 1933 Act, and it's called Regulation A. You could all leverage, without audited financials, through solicitation, whether accredited or non-accredited investors, up to $5 million today, Regulation A on a state-by-state basis. Of course, everything comes with pros and cons. We're not going to go into it unless you have questions about it, and we'll let you ask. There is also a big rise, maybe Michael, you want to talk about 506C, how many deals closed since the law was implemented under the Jobs Act allowing for solicitation?
Yeah, I mean, in 506C, basically we had about, in the last year, we had 18.7 billion, sorry, excuse me. 1,929 deals were done under 506C. Versus 20,650 506B offerings, totaling 668 billion. That right there, that shows there's a market, right, for the non-accredited investors.
No, that's the accredited.
Yes.
So what happened here, and I clarify those numbers, with your permission.
Please.
The Jobs Act was implemented, Title II, 506C, allowing general solicitation. And quite frankly, personally, I thought it would be a major boom in solicitation under 506C, and people would start using and leveraging social media to attract new investors. 1 second, I'll be with you. What happened is, the law was implemented, it has been a year, and it's not too bad for a law that was implemented solely for 12 months to see $18 billion raised for general solicitation. Yes, the burden is on the issuer to verify the accreditation of the investors. Nonetheless, and by the way, there is a solution for that. Just get an opinion from the accountant of the guy, because I don't know anybody who's an accredited investor who doesn't have his own personal accountant. So just get a letter from him certifying that he's accredited and you solve the problem. Nonetheless, people still use the mainstream 506B and use placement agent in conventional way, tapping into their Rolodex in order to raise money. We still believe that this trend is going to shift and equalize. You need to know that there is only 11 million households in the US that are accredited investors. And only 3% of them are actively participating in deal, which means there is a huge scope of accredited investors that are completely out of the loop and don't even know that those deals happen, aside from real estate put aside. So those are very important number to remember. Sir, please, you have a question? Okay, crowdfunding under Title III of the Jobs Act has not yet been implemented by the SEC. People cannot sell the $1 million, so it's $500,000 without audited financials, and above $500,000, something completely incomprehensible, the SEC requires audited financials for up to $1 million raise. So equity crowdfunding, in my view, is not going to be successful because it doesn't make sense for a small company, a mom and pop company, to have to do audited financials in order to raise $1 million. And there is alternatives to it. And one of the alternatives that we recommend is Reg A offering. First of all, there is two types of Reg A. So there is Reg A under the 33 Act, which allows you to raise up to $5 million. There is no limitation on the amount that the non-accredited investors can put into the deal, and you don't need audited financials. Nonetheless, you need a registration on a state-by-state basis. And there is the Title IV of the Jobs Act that hasn't been implemented yet, but we hope will be implemented by the end of this summer. And that's a revolution.
I'll be Reg A Plus. And Reg A Plus will allow you to raise up to $50 million. But the requirement with that is you need to have audited financials, of course.
Now, it's free solicitation. You can use any medium you want under Reg A or under 506C to solicit capital. It's the first time in our history that social media crosses capital formation. And this is huge. So, for the first time, you can knock at every door with a prospectus and solicit capital from people that never heard of you and launch a campaign. Social media meets capital formation. We still recommend to use a placement agent. We still suggest that you have a banker that gets up to date and manage and quarterback those deals for you. Don't go out in the blue, put your YouTube video and think it's going to happen. You need to combine traditional mainstream of raising capital with social media and with your banker. Give yourself some credibility. Hire us. Now, get also an audited financials, a great firm, bring together a real team around you so investors can feel comfortable going with your raise. Now, solicitation is not for everybody, by the way. Some companies are better off not doing that and being marketing and soliciting capital differently. But today, consumer good, biotech, how many biotech deals have been successful in those solicitation offerings?
A third.
A third of all raises were biotech successful raise through general solicitation. People want to participate. It's an emotional investment. And those deals are very crucial when you can finally reach people through social media and get the message out there. Would you like to talk about reverse merger, the decline, and what goes on?
Yeah, so reverse mergers is something where if you have a company that has sound management, sound fundamentals, and you've got a clean shell that's out there in the market, this is an opportunity for basically you to go get liquidity, go get transparency, and become uplisted on the market and get liquidity and give transparency to your investors. Right now we've seen a reverse merger in the market. It's been flat. We had about 173 last year, 179 this year, and we see with interest rates rising, there's potential that there could be a further uptick in reverse mergers as people are looking for more financing, because we see that more of the money is going to valuations of companies that are plus 200 million. We don't have companies here at NIBA that are all 200 plus. So more of these smaller companies are going to look for alternative means to raise capital, and reverse mergers, if you have a sound management team, would be an excellent way. We've got a lot of clients of ours that are clean shells that are looking for sound management, sound ideas, sound investment teams to come in.
So what happened basically is the reverse merger market has been stagnant. It has been the same in 2013 and the same in 2014. For those who don't know what reverse merger is, and I assume I'm talking for the minority in the room, but I'm targeting those guys because they are the issuers, and that's why I want as a client. Reverse merger is a quick process by which a public vehicle, preferably not deemed a shell, will swap his shares for the company's shares and lose its control to the private company, who becomes basically the organic part of the public vehicle. Wow, it sounds complicated. Basically, it's a very quick way to become public and attract cheaper form of financing based mainly from technical investors on liquidity. Companies who would use that system to go public are companies that need quick infusion of capital. If you want to build a long-term story, go back to your fundamentals. Do a private placement raise, whether a 506C general solicitation with no limitation on the amount of money you can raise, no need of audited financials, or a 506B with your banker, or even better, a Reg A offering for the first $5 million, where the shares, even though you're a private company, are going to be immediately freely tradable, and then file a Form 10 or an S1 and become a fully trading public company at a higher valuation because you dictated the valuation of your $5 million on the Reg A because it was non-smart money, non-accredited investors. So those are the different formulas that can be played off. I know it's a lot to ingurgitate in a second, but there is different ways of soliciting capital, bringing capital, securing the capital, and getting listed. Reverse merger, if you do it, secure before the transaction. Either a convertible debt that you can draw on and not based on liquidity, or secure a real fundamental capital infusion on equity because you won't have money until you're secondary. Those are real facts of reviews of companies. Now, there was a few great companies that did reverse merger that are the creme de la creme, but not everybody is belonging to that category.
Yeah, I mean, reverse mergers in the recent press got received negative press because there was a lot of foreign companies that were using it, and so the SEC came down and cracked down. A lot of these companies were Chinese companies, and they said that they alleged that there was fraud going on. Actually, turned out a lot of these companies turned out clean. SEC didn't come in with enforcement actions. And there's respectable companies throughout the past 50 years that have used reverse mergers, such as
stigma. There's a stigma based on it, which we don't believe should be relevant if you have a good, savvy business plan. But there is a stigma attached to it. You need to overcome certain realities. The best shells are shells that went through bankruptcy. You will inherit a history and become the continuity of something that was created before you. Nonetheless, it's easier to attract quick infusion of debt or equity from technical investors. To reach the fundamental players, it's a different ballgame. And that requires from the company's management to come with a structure and a savviness that allows not only for transparency, but also for a strategy that allows the company to grow. And not every management team that we have met has a real answer to that. Only very sophisticated visionary can come up with a structure that allows to scale the money infused in order to build a higher valuation and capitalize on it. The good news is once you're public, you have a printing machine that allows you to print stock, allow you to dilute a lot of your ownership, yet creating anti-dilution provision is feasible, and upon certain milestone, you can reissue those shares to founders, management for achieving those successful milestones and counter that dilution. But we believe that stock is needed to be used as a currency and not just sit on and hope that the valuation will go up. Creating a market is difficult even after a reverse merger. Any questions?
What is the simple cost for a simple reverse merger?
Well, the cost of, in general, for a reverse merger entails, first of all, having an audit. So the cost of the audit can be very variable depending on, well, simple means, is the company with or without revenue? How grueling is the audit process? And usually the hardest part of the reverse merger is really to make sure that the private issuer has a good audit, good auditor, and is ready from a cap table standpoint of view to undertake the reverse merger. The acquisition of shares today on the bulletin board varies between $200,000 and $400,000 on average. That's a cash and carry deal, which means you would buy the controlling block and transition control with a Super 8K following that acquisition. That's the average price, between $200,000 to $400,000, depending on the quality of the public vehicle. That doesn't include the legal cost, that doesn't include the audit cost, and then you have ongoing costs under the 34 Act that are subject to the Sarbanes-Oxley reporting requirement, et cetera, et cetera. Those are additional costs which average about $200,000 a year. So you have audit cost, let's say between $50,000 to $100,000 depending on how complex your company is. If you have a very simple company with no complex financials, maybe $25,000 depending on the audit firm. You have the purchase of a shell, whether you do it for equity or cash, let's say another $250,000. And then you have the legal cost, about $40,000 for a reverse merger. And usually you have an investor that comes in, then you need to file a registration statement, and it's another $40,000 to $50,000.
So for $500,000 you can get away with $500,000, more or less, for a small company.
Yeah, you're safe with $500,000. That's for a reverse merger. Don't do it if you don't secure equity up front. Now, there is ways also of maybe you want to raise money under a private placement before you undertake any going public strategy. All right, any other questions, guys? Or we can go for other financing forms. Don't be shy, we'll answer. You can fall asleep if you want, but you want to talk about something else? ATMs, pipes?
No, I mean, I think we're at, like Sonny said, we're at an interesting intersection where social media is going to drive the force of capital raise. I gave a conference over at New York State Bar Association, about 150 lawyers. You had to explain to them and handhold to them what Kickstarter was, what Indiegogo, what the crowdfunding was, crowd equity, crowd speaking. So right now we're at a time where we can take companies, match them up with social media, get them out to the public, and we've got rules in place where we can activate the capital raise and get quick money to companies that are looking to, between that $1 million to $5 million range.
if you are a private issuer, don't rush to go public without a full strategy. If you're a public company, know that there is alternative ways to raise money at the subsidiary level, and make sure if you have an IP or any substantial asset that it's separated from your company in case shit hits the fan. That might happen. So make sure that if you have any question, our law firm, we're the best in the world, we'll help you. We're there at the end of the thing, the corridor, JS Barkats. We're blunt, I'm French, I do shower, I never surrender, and my team is the best, so don't be shy. Thank you.
Thank you.